Hi, this is Matt with Gray Matter Trading, and today we're going to be looking at the Simple Moving Average, or SMA. The SMA is one of the most widely used technical indicators and is pretty simple to understand and use in your trading. It's calculated by adding the closing price over a given period, then dividing that sum by the period. For example, to calculate a 10-day moving average, you would take the closing prices for the past 10 periods, add them together, and then divide by 10. Pretty simple. The SMA is a lagging indicator, which means that it's a result of the price and it does not predict future prices. How the SMA acts depends on what you have the length set to. Whether you're a day trader or a long-term investor, the SMA can really be applied to any time frame that you're looking at. There's a few different ways to apply the SMA to your trading. The first one we're looking at is moving average crosses. The first one is the golden cross, where the short-term moving average crosses above the long-term moving average, which would be a bullish signal. And the inverse of that would be the death cross, where the short-term moving average crosses below the long-term moving average, which would of course be a bearish signal. The next way that you can apply this is to use the SMA to identify trends. Basically, when the price level crosses below the moving average, you treat the moving average as a resistance level. And when the price level crosses above the moving average, you treat the moving average as a support. And the last strategy that we're going to be talking about is using moving averages as stop losses and profit targets. Say you've entered a trade in regards to the VWAP and one of your moving averages is in between the middle and the top VWAP. Once the price level moves above that moving average, it may be a good time to take profits, or if you decide to stay in the position in hopes that the price will continue to rise, you could move your stop loss up to that moving average to lock in profits. And right here we have an example of a death cross on ticker symbol VZ on the 5-minute chart. You can see here that the short-term SMA crosses below the long-term SMA, and this would be a good time to take a short position. The price drops and begins to consolidate right around here and eventually closes above that short-term SMA. Personally, this is where I would have taken profit, but depending on your risk tolerance, you could have held all the way down to this next crossover here. Here's an example of applying moving averages to longer term, say swing trading. We're looking at Citigroup on the 180-day 4-hour chart. Like I said, we're using longer term moving averages. Here it's the 25 and 50-day moving averages opposed to the 10 and 20-day that we were using on the 5-minute chart. So right here, you can see that the price broke below that 50-day and continued to drop for a solid month, testing this moving average here, and then continue to drop to around the $50 price point right here. After popping back up, there's some horizontal movement here in between the two moving averages, but as soon as it crosses this 50-day, it continues to climb for another solid month, testing that 25-day moving average here, and is continuing to hold that trend. So there's kind of the basics of the SMA. Let me know in the comments what other topics you'd like to have covered in future videos, and feel free to subscribe and follow Gray Matter Trading on social media. Thanks for watching.